Okay. We're not going to drop the ball tonight like Kansas City. We're going to win this one tonight. What do you think about that? You feeling bullish on the show?
Super bullish.
Is that the worst?
Did you hear? Wait, that's a joke. Did you hear that? Super bullish.
Got it.
Play
was
on
that
words?
the worst? Was that the worst game that you can remember? Super Bowl game that you can remember?
There was one other clunker like 15 years ago, but that was pretty bad.
Where it's like 10-6 or something.
No, I'm just trying to think. Did the Seahawks got killed by the Panthers or the vice versa? Either way, the Broncos killed the Panthers. This was bullshit. Horrible game. Horrible game.
Terrible. And they actually managed to hit the over because they had some garbage time drives and touchdowns. But like the first 2 and 3 quarters of the game is just like
it was tough.
Unwatchable football.
The better team won. Clearly, they were the better team. They would have won that game 8 out of 10 times or whatever. They were the better team. They won. They deserved it.
I fully agree. You know what's funny? Like all the teams watching that are going to overcorrect now, and they're going to be taking all these front four guys from the draft. Like everyone's going to say, this is the new way to play football.
Well, yeah, everyone knows if you can get pressure with the 4 guys, you're in good shape. Giants did that a couple of decades ago or a decade ago.
Yeah.
That's the way to do it.
Well, it's over. It came, it went, and tonight is an all-new edition of What Are Your Thoughts? My name is Downtown Josh Brown.
Talking to the mic. Talking to the mic.
Okay. My name is Downtown Josh Brown, here with Michael Batnick, as always. Michael, say hello to the folks.
Hello, hello.
All right. Got all kinds of people in the chat tonight. Regulars, newcomers. Jay Minter is here. David Graham. Dr. Horton. Benjamin, we see you. Chris Hayes, we see you. Joey Gow. James Sykes. Who else is here? John. Evan Beauchamp.
Everyone, dude.
Trump and Dad is here. All right. All right. We got a full house. I'm pretty excited. Nicole's in the chat patrolling. Everybody be on their best behavior. Tonight's show is brought to you by a new sponsor to the show. I'd like to introduce you guys to Kelly ETFs. And Michael, they have a particular suite of ETFs. That's what they call it, right? When there's a couple of ETFs all in the same.
Let me tell you something. Kelly U.S. Cash Flow Dividend Leaders Index. That's a cows ETF index. It's tracked by the cows and HCow ETFs. HCow tracks the index and then writes calls on the constituents. So what are we talking about here, Josh? What are we even talking about? These are cash cows, okay? Free cash flow. This is not...
So wait a minute. Cash Flow Dividend Leaders Index is tracked by cows and HCow. If you want to just own the equities that make up the cash flow dividend leaders, the cash cows, you would buy cows. Mm-hmm. If you want the hedged version
Option
that writes
overlay.
covered calls against options overlay to bring in income, you would do HCow. What's like the what are the stocks in here? We have a couple of graphics.
So look, the top 10. This is like not a closet index or anything like this, right? Like this is not the Mag 7. This is the real shit. Free cash flow. So matter of fact, the Wall Street Journal, our friend Spencer Jacob wrote an article today. The Mag 7 or so last year, cash cows are the new kings. So good timing with today's show. So free cash flow. That's the name of the game. Cash
cow is kind of cool because it's like a proxy for quality. I think, like well, it's hard to generate free cash flow with a bad balance sheet.
Cash flow, yeah, exactly.
Yeah, but I like that it surfaces companies that people don't talk about a lot. So, all right, very cool. Here's how you can find out more. Go to kellyintel.com. That's KELLY Intel.com to learn about cows and HCows and all the related disclaimers and disclosures apply. Okay, I wanted to start with just a roundup of where we are year to date in the stock market, because this year is turning out to be a little bit different from the experience of the start of 23 and 24, and different in sort of a good way, depending on how you're allocated. I like a tape like the one that we're experiencing right now. These are the types of markets that I enjoy the most. So I wanted to kind of walk you through what's happening here and get your take. Let's start with the DGen Dow. We launched the DGen Dow last fall.
Created. We didn't launch anything.
We didn't launch it. I'm sorry. Apologies. What we were trying to illustrate last fall was like all of these junk companies that were left for dead in 2022 were starting to make a price comeback. Like they were starting to rip again. And it was a lot of fun because here are for people listening and not watching, it's like NVIDIA, of course, not junk, but being the people that are involved in the stock were increasingly acting like degenerates via the options market. But like Palantir, Roblox, Reddit, Riot Blockchain, Rivian, a lot of them start with an I, which is interesting. SMCI, which is Supermicro.
Wait, I'm sorry. What
GameStop.
What do you mean a lot of them start with an I?
R.
Oh.
Just did like 6 in a row.
I thought you said I. I thought you said I. I misheard. My bad.
No. You got the coin-related stocks. You got the Carvanas. You got the GameStop AMC contingent. Robinhood's in there. MicroStrategy, which I know is now just strategy. But like, here's the DGen Dow year to date, up 5.6% and doing better than a lot of the mega cap tech names, which we're going to talk about in a second. What are your thoughts on the DGen Dow's prospects for 2025?
Throw that chart back on, if you will, please. So the chart on the left, that looks very much like ARK, and I'm looking at ARK on my screen right now, and it looks identical. And that's not disrespectful, but like these names are coming back.
These are her stocks. These are DraftKings. These are her stocks.
Like Teladoc. Yeah, DraftKings is great.
Not in here. We don't have Teladoc in the DGen.
No, I'm just saying, but a lot of these stocks that were the 2021 darlings that got annihilated, they're coming back.
Yeah.
Signs of life.
ACHR is in here.
What's that?
Archer.
Oh, okay.
I think it's flying cars. Like it's like that's what's in the DGen Dow.
Do we have the rigatoni in here? Or the Rigetti Computing? Do we have those names in here?
What the fuck is that?
Ionic?
Oh, the quantum computing.
Do we have these?
They don't make the cut yet. They're too small. If that makes sense. We have to have a cutoff. With like you can't have the tiniest stocks in here.
I haven't looked at these in a few weeks. They're rolling over. They look like shit again.
We will have to revisit the weightings here, though. I think at some point this quarter. Like not the weightings, the holdings.
Constituents.
I think we're equal weighting. If I'm not mistaken, I don't think this is a market cap weighted thing.
All right, what else inside the market has your attention these days?
Bitcoin and gold. Here's 3 months. Obviously, Bitcoin blue, gold yellow. Bitcoin up 21%. 21% over the last 3 months, and off to a pretty good start this year. But gold really is doing better if you just start from New Year's. Gold is like sort of taking off here. And I think that's just a function. I mean, who the hell knows what moves gold these days? I think it's a function of socioeconomic volatility.
Sure.
Not geopolitical issues that refuse to go away, and just people wanting to look for some sort of an asset that's not being controlled by one political party or the other. I think that's as simple as that. I don't think it's that complex. And just look at the central banks, China in particular, loading up on gold.
Dude,
it's probably not
okay
a
to say
train that's about to
it's
stop.
okay to say we don't necessarily know why gold is golding.
Well, we do get reports of large purchasers, foreign central banks. Like that's not really open to interpretation. They're
like
buying or selling.
if you're saying they're because like geopolitical, like Trump stuff, like gold didn't do anything during Trump's first administration.
No, I think more like certain foreign countries looking at the example of the United States and its allies trying to cut Russia out of the financial system, and Russia finding a workaround by selling oil to China, and you have companies now very comfortable reserving in gold and selling U.S. Treasuries, and that is not a new phenomenon, but I think it's accelerated.
Okay,
so
what else is on your mind?
I don't really have a story for why Bitcoin is up other than it's 2025. Mag 7 ETF. Let's throw this up. We're going to spend a minute on this because I think it's probably the most interesting thing going on. Adam Parker did this really great walkthrough of what's happening with the Mag 7 and why it might be a time to sell these stocks. Wait, chart off for a second. So, according to Chart Kid Matt, the Mag 7 has actually detracted from S&P 500 year-to-date performance, not by much. The other 493 names are up 3.45% year-to-date. The Mag 7 is slightly negative, like less than 0.5%.
You know what I love about the Mag 7 right now? Like they're all doing their own thing.
Yes.
It's not one trade at all.
It's not one trade. But the point is, what's different about this year versus the last 2 years is that the rest of the market is carrying the index, and the Mag 7 is not contributing.
I love it.
So that's a change of pace. The other thing worth saying is that Mag 7 companies are a pawn in the U.S. versus China trade war. And there's a bunch of stories. Bloomberg wrote about this. China is considering launching an antitrust investigation into Apple's App Store practices. China's State Administration for Market Regulation, or SAMR, announced that it's opening an antitrust investigation into Google. Some of the Mag 7s have no business in China. Meta being an example. Yeah. Some of them have big business, like NVIDIA. Here's another story. Financial Times. Chinese officials are considering launching a probe into Intel on top of an ongoing investigation into NVIDIA.
Oh, stop. They're already dead. Leave them alone.
It's all a part of China's effort to punish the U.S.'s most prominent companies and inflict its own pain on the U.S. as the two nations battle it out. Okay, so that's the thing that's happening. So Adam Parker wrote, over the last several years, we've maintained the view that long-only U.S. equity managers should be at least market weight the Mag 7. And they had a whole list of reasons. Don't underweight these stocks. Mm-hmm. He has just said now he's changing his mind. Now it's time to equal weight them. Meaning if you're going to own them, bring them down to size relative to the rest of the index and not own them in a market cap weight. So it's not quite a get out call, but I think it's a little bit ballsy.
It's like a chill out call. It's a chill out call. I like it.
I kind of like it a little bit. And basically what he's saying is that the company specific risk, put that chart back, is fairly low for the Mag 7 stocks. All 7 are more macro than the average stock in the S&P 500.
This surprises me. I would have guessed like there's more idiosyncratic risk with like Tesla than Apple.
And it turns out that there wasn't. So the rationale for being at least market cap weight was that the amount of returns, the 7 factors for why these stocks work. Equity market beta, 2 different size factors, mega versus large versus mid cap, and mid cap versus small cap. Substance, high quality versus junk. Style, growth versus value. And then there's the liquidity factor. These are easy stocks to buy when you want to get long really fast. Mm-hmm. And momentum, that which is going up will continue to go up. So those were the factors that drove a lot of the rationale for being market cap weight these names and not trying to be smarter than the market. Adam is basically saying things have changed, and these stocks might be a sell at this point. We have one more. I think we have one more.
What's his reason? What's his reason?
What are we looking at here? Oh, so this is just Wall Street. So this is a way to look at sentiment. 404 buy ratings, 76 hold ratings, 24 sell ratings. Mm-hmm. The percentage of sell ratings on the Mag 7 names is 4.8% of all ratings.
And Tesla, it's like much lower.
Yes. One other thing worth pointing out is exposure of the top 7 in the top 500 U.S. equities. Let's put that chart up. He's saying the beta here is at a 25-year high. And
interesting.
Problematically, capital intensity has also evolved. And I wanted to get your take on this. Last chart for this set. Basically, part of the allure of these... nope, not that one. We're looking at... This is it. CapEx to sales of Magnificent 7, now at 12% and projected to rise.
Yeah.
One of the primary selling points of why you want it to be in these names, I don't want to say asset light, but high profit margin.
Yeah.
For as far as the eye could see. And that's what's really changing here. If you just listen to the CapEx plans that they laid out on their last calls, they're talking about spending a combined $300 billion.
Amazon's in for 100.
Yeah. So it's like, it's getting to the point where can we really say that these are not capital intensive companies?
Well, nobody's saying that. Their margins are still ludicrously high, and I think they're doing a really good job telegraphing to the street exactly what their intentions are. And they sold off Google. Amazon, they're giving the benefit of the doubt. So yeah, there's going to be a point in time, I don't know when, where the market says, hey, ladies and gentlemen, like we got to see some revenue behind these numbers. A lot of spending.
You're going to be 14.5% capital spending to sales ratio by the end of 2025. If you don't have the concomitant increase in earnings guidance for 2026, you're going to have a problem here.
Big time.
Okay.
Wait,
I'm going to go
throw
out
the chart
on a limb.
back on. Throw the chart
Which
back on.
one?
Josh, keep talking. The multiple. Backwards.
Capital intensity?
No. The median PE of the Mag 7 versus... There we go. So this is the ratio of the top 7 versus the 493 and the median forward PE. And so, yeah, Josh, you're right. These stocks, as we've discussed, are getting the benefit of the doubt that all the spending is going to turn into revenue, and it better soon.
Well, profitable revenue and sustainable moats. And what might be happening is an arms race where Amazon spends 100 and Microsoft spends 75 and Meta spends 60, and no one is doing it to any sustainable end. Like there's no moat because the technology is rapidly advancing to the point where competitive advantages are being flattened.
Okay,
and that's a concern.
Well, not yet. It is. I mean, it will be. But these companies, they're all saying the same thing to investors. This is an existential threat, and we would rather overspend than underspend. And so, right now, investors are giving them the benefit of the doubt, and we will see what happens.
Yeah, there's a lot of building, and they will come arguments being made, and we have to spend now because if we underinvest, and someone else is going to overinvest.
They're basically saying like, give us 12 months or whatever.
Well, the market's not. So this is the point I want to make to you.
Okay.
The market has decided so far we're not interested in that story as much as we were last year.
Yeah.
Well, every single Mag 7 was negative after reporting, other than Meta, which is spending the least and does not run a cloud data business. So take that however you want to take it,
Apple
but
too.
that is the reality.
Apple too. You're right.
Okay.
You're right.
Apple too.
There are chinks in the armor forming. You're definitely right.
Here's the Mag 7 equal weight ETF. Does this look bullish to you?
If you zoom out, yeah.
But I'm not zooming out. I'm saying this is intermediate term. I'm showing you the last 90 days.
Okay, well,
this looks like
it looks fine.
A nowhere's land.
Looks fine.
Okay. I'm going to tell you that I think.
How about this, dude?
Year,
Wait, well, hold on. What do you want? I know you don't want these names to go up forever and indefinitely. Like, I think a pause here is very healthy.
I think the Mag 7 at equal weighted will be negative in 2025.
Good, fine.
Would you bet against that?
Because it's been up 30% a year for the last 10 years.
No, I know.
Like,
I know. You're right.
Fine,
You're right,
good.
You're right.
Take a year off. Take a break.
Would you bet against it?
Meaning, would I bet on them being higher?
Would the equal weight Mag 7 up or down on 2025?
I'd say up.
10 months from now.
I have no conviction. Up.
Say up. Okay. I'm going to say down.
Okay.
I don't know anything more than anyone else, but that's how I'm starting to feel. Let's put NVIDIA up. This is the only one that hasn't reported yet. Not great trend-wise. It's had a good week or two, but just generally speaking, this, ladies and gentlemen, is what we would refer to as a short-term downtrend. Again,
come on.
Pull the chart back 3 years, and it's different. Yeah. Of course, we all understand that. I'm just describing the price action year to date.
Okay.
Things are sort of a little bit different.
It's fine. I mean, okay. It's in the gap from that DeepSeek debacle. That was down 17% that day. It's recovered a decent amount of it. But yeah, it's trendless. It's going sideways.
But not all of it. But next week will be a little bit of a moment of truth. They'll report on the 25th. All right. Winners and losers this year, sector-wise. Here's the best performing sector. XLC, which is the communication sector.
So that's Facebook.
Yeah, a lot of the companies in here, people look at as tech. It's Netflix, it's Meta, it's Alphabet. Up 6.6% on the year. Let's put up XLY. This is the worst performing sector. Consumer discretionary up 0.9%, up less than 1%. Not bad.
Well, this is being dragged down by Tesla. What's Tesla? 20%?
Well,
Let's see.
So I was going there next. Yeah. Tesla
15%.
Okay. Tesla from December 17th, which was the top. I'm not cherry picking a date. I'm saying Tesla has added $791 billion in market cap over the last 3 months. Right?
No, wrong. So this chart, we shared this on the show on December 17th, which just so happened to be.
That turned out to be the top.
That was the exact top. So the next chart shows where we are today.
It's leaking market cap on a daily basis.
So on December 17th, it had a historic 3-month run, added $791 billion in market cap. Over the last 3 months, it's given away 67. So it's right now, this is kind of wild. I had Sean do some work for me. So it's in a 32% drawdown. Maybe there's some, I don't know, investors are concerned that the CEO and founder changed his name to Harry Balls and put circumcisions at a discount, 50% off in his bio on Twitter.
Maybe like Heil Hitler at the inauguration.
Maybe people are not. Maybe people are not into that. So anyway, but my point is on the stock itself. Tesla is a wild company, stock-wise. Chart on, please. Thank you, Sean, for doing this. So over the last chart on, please. The annualized returns. Here we go. So over the last 5 years, Tesla has annualized the shares at 45% compounded, which is
insane.
Yeah. If you rewind back, if you zoom out 10 years, 37% a year. One of the top, 10 performing stocks, just crazy numbers. But at any point in time over the last 5 years, if you threw a dart, or if you were a shareholder over the last 5 years, at any point in time, you were 31.6% away from its all-time high. It is a wild stock.
So if you look at certain enclaves of social media, which are non-MAGA enclaves, some of the most shared and retweeted articles and headlines are about European sales of Tesla cars plunging, like Germany and France, and kind of like people just finally, they've had enough of Elon Musk. I don't think that really matters. I understand that sales might be down, and you're watching the stock price go down and you're drawing some sort of correlation. I think the shareholder base is not here for the quarterly European sales of Model 3s. I think what's really keeping people invested in the story is the robot stuff. Mm-hmm. And as long as he can keep that stuff center stage in his public commentary on Tesla, I think I don't think you'll lose the entire gain that you got from the election. I think they'll
I agree
hold
with you.
Some of that.
I agree with you. My take on this is that the chart that we just shared, a $791 billion increase in market cap over the prior 3 months, was an insane run. And I think things got out of control. And this is it's hard to say a 32% correction is healthy, but this stock does this all the time. This is not new or unique to today. This is just what the stock does.
I think a lot of people who politically are not happy watching what he's doing right now, they are wish casting. And they're looking at this falling stock price and leaking market cap, and they are dream weaving this story where finally, Elon's about to get it. And I don't see it.
I think it'll be fine. Okay, I want to talk about.
Although put the tweet up. I mean, this is what we're doing. This is where we are now.
So he changed his bio, but
he changed his name so that the newscasters, when they comment on him, would have to show this. Because they show his tweets to dunk on President Trump or on Elon. Whatever. So this is the meta joke that his sense of humor is not mine, so it's fine. But this is what's going on.
Okay, I believe was it Nick Hollis or Sembalist? One of the two geniuses told us that one of their favorite economic gauges are ISM new orders. Do you remember one of them saying that? Okay. Yeah. So we got some good news. This is from Sentiment Trader. The ISM new orders index, a key gauge of future manufacturing activity, climbed above 55 for the first time in 32 months. hinting at a manufacturing rebound. Similar upturns have signaled strength in stocks, particularly in cyclical sectors and manufacturing-driven economies. Now, who knows how much of this is, wishful thinking and it's a survey, but whatever. But like still, historically, this has been a good thing.
So they call people that are like managing these plants and assembly businesses, and they kind of get a survey of like what's happening with business. And, it's a survey. So to follow it month to month is probably not that meaningful. But when it breaks out like this, there's probably something there.
So, of course, a lot of this, like every other survey, is political. But I've said a bunch of this could be self-enforcing. If people are feeling better about the future prospects for the economy, they're going to spend more.
Yeah.
That's how it works.
So you know what's tough about this? We don't know who they're talking to, like what industries and how many people are in the survey. We have no idea. This is one of the surveys that Neil Dutta told us to throw out. Just FYI.
Was it?
Yeah.
All right,
all right.
This.
Do you know what this company is? Doximity?
I have never heard of it.
So this is like one of the reasons I love this market. Almost every day you have a stock doing what this stock did last week and just absolutely exploding out of nowhere, and not for no reason, but because of an earnings report. And you're basically in a situation now where moving away from Mag 7 and finding other ideas and other names is no longer hurting your performance. Remember how lopsided 2023 was? You had like almost no stocks beat the index. That's, again, I made a prediction a few minutes ago. I think you'll see the Mag 7 underperform. Or excuse me, that's not what I said. I think you'll see the equal weight Mag 7 be negative on the year. That doesn't mean necessarily it won't be a good year for investing.
Yeah.
Because I can envision a year's worth of this sort of thing.
So this is a digital platform for U.S. medical professionals?
Yeah, it's like converting digital records into cloud-based blah, blah, blah. Let me show you some shit. Here's Cloudflare. This hit the best stocks in the market list a couple weeks back, and look what it did since then. It just absolutely exploded. This is why we keep that list. This is cloud data. It's like Snowflake, but a better version these days. Like, they don't blow up every time they report earnings. And they had an incredible report. Just listen to the numbers. I know that you don't know the business that well. Fourth quarter 2024 revenue, $460 million, 27% year-over-year increase. Last quarter was a 27% increase as well. Customer expansion added a record number of customers spending over $100,000 with them annually. That increased 27%. They now have 3,497 six-figure customers, and customers spending more than $1 million grew to 173, a 47% increase year over year. So their biggest customers are growing in number and spending more. Improved profitability, non-GAAP operating income, $67 million, operating margin of 14.6, big improvement year over year. $47 million in free cash flow for the quarter, $166 for the year. Big guidance, projected revenue, $2 billion revenue, 25% growth this year. Like, these companies are out there, and they're not trillions of dollars in market cap. You could. You know what I
love? You know what I love? That your list of the best stocks is purely technical, but these stocks aren't on the list for no reason. They're breaking out because the fundamentals are.
I'm so glad you said that. You can't get on my list and stay there because somebody memed you. You can't be a meme stock and be on my list. And if you're there, it's a very good bet. You're doing really well.
Yeah.
Okay. A couple more. So here's Doximity, DOCS, great ticker, Dox. Up 56% year to date, dude. So Cloudflare is the #1 stock of the year, up 60%.
And the S&P?
Russell 1000.
Okay.
This is number 50. Dude, this is number 2.
This is a big company. It's $60 billion. Oh, no, that's net. My bad. Net is 6.
No, net's much bigger.
Yeah. Dox is 16.
All right. So this is an IBD stock, Dox. The stock went up last week 36% in one day, breaking out of a consolidation. It had a massive, massive one-day rally. And obviously, we're not saying go chase the stock. But again, here's another company. Earnings surged 55%. They beat the street by 34 cents, which means the people covering this company have no idea what's going on with it. Sales up 25%. Destroyed the analyst expectations. There's an analyst, Ryan Daniels, covering the stock for William Blair, described the quarter as, quote, pristine. Put simply, it was a stellar quarter for the company across all key operational and financial metrics. Just a beast. Here's number 3 on the year, Palantir, plus 54%. We've talked about the stock last week. We don't have to rehash it. An incredible earnings report and just an awakening on the street that this thing is serious business. Constellation Energy is 4, up 44% year to date. These utilities all got whacked during the DeepSeek thing. This stock has gained almost all of it back. Just incredible. They got a government contract at the end of January, $1 billion 10-year contract to supply power to federal agencies. They are the largest carbon-free energy producer in the United States, and blah, blah, blah. Last one, Spotify, plus 43%. You're in this or no?
No, this is my biggest regret.
Oh, my God.
I know.
Revenue up 16%, $4.5 billion. Blew the analysts away. Achieved its first full year of profitability. Net income, $1.21 billion for 2024. So this is like a real, this thing has arrived. $1 billion in profit for the year. There's not that many of these.
Josh,
and,
I wanted to, just speaking of individual stocks, I wanted to give you a pat on the back last week, but I forgot to. CrowdStrike hit an all-time high. You caught some shrapnel as if you caused the glitch when this stock got creamed, but all-time high. Haters are quiet these days, and Reddit also, credit to you. You bought Reddit after the gap higher, right?
Yeah.
And it's like doubled since then.
Do you know some fucking psychopath called the firm and started yelling at a girl that answered the phone about CrowdStrike, like blaming me for the IT outage, and the stock collapsed to 200.
Nothing surprises me.
Now it's 450. Can you call us back?
I forgot to tell you he called last week. I wanted to thank you.
Yeah. What do you want to tell me now, tough guy? I'm not responsible for global IT outages. I don't know if you know that. Last thing. How many? Take a guess. Don't look.
7.
Close your eyes. How many users globally does Spotify have? Just hit a new record this quarter.
Okay. 37.
Hold on. Let me give you the amount they added this quarter.
Okay.
As a clue.
Well, I was going to say 37 million.
37 million total?
I don't know.
Okay. They added 35 million last quarter.
Oh,
How many do you think it is now?
Wow.
I wouldn't have known either. I'm just curious what you would
All right.
guess.
So what is Netflix, like 300 million users? Or am I making that up? Something like that?
That sounds like it's right.
Okay. What's Spotify? 200 million?
Dude. 675 million users.
Wow. Yeah, dude, they're crushing it.
Now that is the cue to buy the stock. Prior to when they get to 500 million users, you just buy the stock.
I can't. It's too late for me.
No. I'm saying revisionist history. I didn't buy it either.
I'm an idiot sandwich.
Any company that can amass 500 million users, paying users, you buy the stock.
Yeah.
They're gonna find a way to make money from an audience that size.
Enough. I know. I can't look at the stock
up.
anymore. All right. Okay. Just fucking launch it. That's the headline for this topic. Everything is coming to market, Josh. Balchunas tweeted, "There's already been 100 ETFs launched this year, on pace for 1,000. For context, the record...
It's 20 a week?
The record was last year, 720, which blew away the previous record of 515. So this will shock no one. Trump wants to manage your investment portfolio, is a headline from the Wall Street Journal. Trump's social media company, Trump Media and Technology, said Thursday that it has applied for trademarks on a series of ETFs and SMAs. They include funds labeled Made in America and Energy Independence, which will launch later this year. Sure, why not? Annual leveraged ETF launches, again, from the folks at Bloomberg. listen, I'm not even mad about it. Like if there's a demand from users, there will be supply from the asset managers.
Let's look at a few of these though. I don't even know what the hell is going on here. Like, all right, that's a Bitcoin one.
Right. No, listen to this. Listen to this.
What are they launching?
Balchunas tweeted, "Holy hot sauce! Trader, which is an ETF provider, is proposing a 2x Rigetti, which would have an estimated 90-day volatility of like 600%. For context, that's triple 2x MicroStrategy ETF and 50 times the S&P 500. Half of these in the same. Okay, so Balchunas like, what's hotter than a ghost pepper? Because I need a new metaphor. So we're looking at 2x long the quantum computing stocks because, why not?
You remember when people used to get like mad about like how many ETFs were launching? That was like a big fin.
Oh yeah, there's more ETFs than stocks.
What do you care? If people want it, they buy it. If they don't want it, they don't buy it. Is there a gun to someone's head that they have to buy? Like what? I don't even know what these things are. iShares Large Cap Max Buffer December. Whatever. Like, buy it or don't buy it. What do you care what other people do? I never really understood that rage at like all the ETF launches. If these things don't raise money,
they go away.
There's no press release. They just are quietly strangled and put out of their misery for the most part.
I guess the thing is like that a lot of these are like just money incinerators. Like obviously not all, but people on balance. But I guess to your point, people can do whatever they want.
I want stupid people to have their money incinerated. I don't think that we're doing anyone any favor by like not letting them learn hard lessons. Yeah. How do you go from stupid to smart? You incinerate some money. There's no other way.
Yeah.
How do you wake up out of your TikTok induced stupor and start figuring things out? Probably it's not going to happen because somebody like does a motivational post on Instagram or TikTok. It's going to happen because you're tired of getting fucked over. I think that's like the best version of the markets policing themselves is for people to get the real world education that only 2x levered Rigetti computing can provide.
I'm looking for a tweet that I can't find.
Fan.
But all right, so you want more? So why stop at 2 times?
More, 8 times. Let's see how quickly we can teach these lessons. And not everyone will learn them, but the people that do, it's like, oh yeah, when I was 24 years old, I blew up $700 in ETFs. Now I have $500,000 and I don't do things like that because I learned.
That's generally my take. I wish these products didn't exist, but whatever. It doesn't matter what I think.
I'm almost like these days, dude, I'm bordering on just complete nihilism. Somebody sent me a link showing that Google Maps changed the Gulf of Mexico to the Gulf of America. And I said that we live in North Korea now. That's it.
I mean, come on.
There's no more norms. There's no more rules.
All right.
It's just like
I get it. That's a come on, that's a bit of a leap.
I'm saying like focus on yourself in this era. Like don't rely on anyone or anything or any institution. Nobody's going to be there for you. You've got to learn a little bit of self-reliance in the new Wild West era that we're in.
That is true.
You might love it. You might love it. You might hate it. But either way, nothing you could do about it. It's going to run its course. And either this is how things are for the rest of our lives, or the pendulum will swing back and all of this stuff that's happening now will be repudiated. I don't know which outcome we're going to get.
Remember in Don't Be a Menace when one of the Wayans brothers is like, message? Which one was that? That was you just now.
Okay.
Not Damon.
That's don't be a menace to society. It's
don't be a menace to South Central.
Marlon Wayans.
It wasn't. It was the older one.
South Central. It's Marlon Wayans. And,
no, I'm saying, but the guy that said message, it was like the older one.
Oh, that's Dame. That was Keenan Ivory Wayans in a mailman uniform.
Yes.
Here's the message: nobody's going to save you from these ETFs.
Yeah, no, you just deliver the message.
These stupid products.
Yes.
Okay.
Yeah.
Smarten up.
Smarten up. You're right.
Pay more attention to us, and we'll get you through it. And we ain't crying about ETF launches. We're adults. We're over it. Okay. Bill Ackman really likes Uber, so I like Bill Ackman again now.
Josh texted me twice this week. Don't sell Uber.
Dude, I almost DM'd him. I don't think he would respond, but I was almost like, smart decision on Uber. And then I looked at X, and I'm not following him, so I didn't do it. So here's what's going on. I was getting killed in Uber since last summer, basically, when the cyber taxi stuff started and the Waymo stuff, and there was this idea out there that like autonomous vehicles, therefore no need for there to be an app or a network or human drivers. Or sure, Uber reported an amazing quarter. Stock sold off anyway. Somebody bought the dip.
We bought more.
I bought more.
I bought more.
Pershing Square bought millions of shares worth of stock.
I bought like 11 more shares.
All right, let's do the chart. Ackman tweeted about Uber on February 7th. He said, beginning in early January, note the beginning part. Beginning in early January, we began acquiring a position at Uber. Today, we own 30.3 million shares. Uber added $7 billion the day of Ackman's tweet. And I think that he's going to do well with this because these are his types of stocks where it's like this name brand, great company where there's a misperception of the market that something they're struggling with now is like this insurmountable problem. And it turns out not to be the case. And a really great example of that with Ackman is Chipotle. He started buying Chipotle in 2016.
That was a home
when
run.
This thing was like a few months removed from
the E. coli crash.
Right. And it was like 7 stores across the whole country where they were mishandling the fresh ingredients. Mm-hmm. They had an E. coli issue. I don't mean to minimize that. The stock is up 600% since Ackman came into the name. And I don't know if he came in with a 13D right off the bat and was instantly a large shareholder, but he bought it. They were calling him Taco Bill.
So what does he want with what does he want with,
a lot of
like
the stock.
What does he want with Uber? Is he looking for like board seats or
No, it's not activism. He's like Dara is good at this. He's like, I've been aware of the company. Some story about like Ed Norton, the actor, introduced the app to Bill Ackman in San Francisco sometime. I don't know. I don't really understand that, but he's like a fan of the business. He thinks it's well managed. He's not going activist, at least not yet. If the stock goes down a few points, that might change. But I think he sees what I see. It's great that there's autonomous cars. Uber will make a lot of money. Their highest expense is the take rate to the human driver. Nobody wants autonomous vehicles more than they do. But somebody has to manage the fleet. And there are going to be times when there aren't autonomous vehicles. So if you're just on the Waymo app, it's not like they could flex you over to a human driver. If you're getting an autonomous vehicle on Uber and one is not nearby, okay, fine, I'll get a human driver. I don't care. I just want to get picked up. That's what Dara is building. And there's room for multiple autonomous taxi apps. I still think Uber will end up being the biggest by far. And I think they'll be the center of the ecosystem. And I think that reality, when it dawns on the rest of the market, will take the stock above 100. So nice, great minds. Bill Ackman and myself are thinking alike here, and I'm pretty bullish on his involvement. What are your thoughts?
Yeah, I think it's going way higher. I mean, I agree with you. Agreeing
Think
with
he's
him.
gonna buy more?
It sounds like it. Well, listen,
I
they're
do
buying.
too.
They're buying back stock. He's buying stock. Why would you sell it?
Yeah. I think he has $2.5 billion worth of stock. Here are his other large holdings. This is as a percentage of Pershing Square. He takes huge positions. I mean, Brookfield, Hilton, Chipotle, these are 13% positions in the fund. QSR, Restaurant Brands International, that's Burger King. And Howard Hughes Holdings, which I think he's the chairman of now. But he takes big swings. So $2.5 billion might just be the opening, like the appetizer for what could potentially happen here.
Okay.
So.
All right, I'm going to make the case for financials. This is bullish, man. I got to tell you, XLF is the second largest sector in the S&P 500 behind technology stocks. And you mentioned that the Mag 7 are down on the year. Well, guess what is way the hell up? Financials. So even like we always speak about Morgan Stanley and Goldman. We follow their reports. They're kicking ass. Those stocks are doing great. But like, look at, and no offense, Citigroup, Bank of America, Wells Fargo. These are 10-year charts, and they are in some cases at the upper end of their range, or in the case of Wells Fargo, and who's talking about Wells Fargo, fresh 10-year highs. So these are the financials that I own personally. Next two charts. In capital markets, I own S&P Global, which broke out to a new all-time high today after reporting earnings, and Intercontinental Exchange, which is the New York Stock Exchange. This broke out to a new all-time high the other day. So any capital market stocks look good. NASDAQ looks good. They all look good. Next chart, please. In private equity, I own Blackstone and Blue Owl. These have, pulled back, giving you a better entry point.
Blue Owl is like private credit, right?
Blue Owl is the biggest GP staker, as far as I know, in that space. So they are, the private credit as well. These names are, the businesses are on fire. The stocks look great. Financials looking good is a good thing. I looked at stocks that were within 5% of their 52-week high, and there's 127 names in the S&P.
Yeah.
No, I'm sorry. So 112 names in the S&P 500 are within 5% of a 52-week high. So 1 out of 5. Pretty good. And 27 of those are financials. So these are the names that are within 5% of their 52-week high.
Yeah, 88% of S&P financials are above their 200-day.
So every subsector,
all of them.
Every subsector is working.
It's really hard to not be making money in that space this year. It's just it's game on.
And these have been dead forever. Like Wells Fargo.
Yeah, John, put the chart back up with S&P Global at the top of it. So I pitched Al Michaels, the competitor to S&P Global, which is Moody's, but they both are effectively in the same business. They're selling credit research and credit analytics to hedge funds, private equity firms, private creded firms, issuers, buyers.
Moody's looks so sick.
Moody's looks sick right now.
I should buy this too.
This is the same chart though, S&P Global. I think like Moody's, there are no sellers in the stock right now. I don't know if that'll change, but people want to be in that business. It's an amazing business. Selling data, credit ratings, selling insights.
Well, Howard talks about the degenerate economy all the time. These are the biggest winners. People are trading their asses off.
Well, every issuer has to get you need published opinions on credit, on bond issuers. And every buyer, every investor in the credit markets, they rely on third-party ratings and insights. And then you've got this whole AI play where these companies are selling like 100 years worth of financial data to all these people that want to build AI trading models and blah, blah, blah. There's just so many different ways for these companies to win. And they are like systemically important to the whole ecosystem. You almost can't do business without paying them. They are the toll takers of the financial markets.
So I would say the risk to some of these names is like they are really front-running capital formation. If the window does not open, these names that got ahead of themselves. So to me, that's the biggest risk. But game on so far.
Yeah, great area of the market to be in, and I don't think that necessarily needs to change anytime soon. Probably, look, we just went from a 24% probability of a rate cut at the next meeting to a 5%. They're going to keep that rate high, for better or for worse. And I can't help but conclude that higher rate means more profit for financial sector in general. That's why they all look like this.
By the way, last year you made the case that like these companies, I think JP Morgan was worried that they were going to have to lose some money, that they were going to have to raise their rates in order to keep customers. That never happened. They're taking it all.
Yeah, I think part of the rally in financials last year was like the reserves being dropped back to the bottom line because they just weren't needed. When companies think that there are credit risks coming or losses coming for their own lending, they will put money aside literally to deal with that. And then if those losses don't materialize, they drop those reserves right back and it becomes net income.
Hard to be bearish when financials look like this. And again, things could change, but for now, they look pretty damn good.
Yeah, and politically, no one's fucking with this part of the economy. That's not on the agenda. There was some talk. Trump made an offhanded comment about the carried interest loophole for income tax, where obviously KKR and Blackstone, the way they make their money is carried interest on the investment portfolios that they oversee.
They're not in any danger.
He made an offhanded comment and people were like, what?
Yeah, come on.
A reporter went to all these private equity companies and asked them for comment. Nobody had any comment. The worst thing they could do is turn it into an issue. It's the kind of thing that like just kind of slipped out and they're just going to pretend it didn't. And it'll be business as usual for these stocks.
Am I going to get your mystery chart? What do you think?
No, you're not going to. And it's not your fault.
I had a feeling.
I think you're more of an ETF person than a stock person. And I'm giving you a stock. So I won't think any differently about you.
Okay. Okay.
This is, all right, so let me set this up. It's a Dow stock. So I'm narrowing it down to 30 names, which is a pretty good hint. Okay? Mm-hmm. And company reported earnings today.
The company report. Oh, is this DuPont?
No.
Okay. Who else reported earnings today? Could you give me anything else?
Ask me for something.
Is a company based on the West? Is a company based on the West Coast?
No.
Okay. Is the CEO's name Paul?
Excuse me. Reported yesterday. My bad.
Okay.
So it all blends together. Reported this week.
I don't know. Give me like something.
I gave you some shit, dude. It's a Dow stock.
Okay,
I gave you a 1 in
stock.
30 chance. You guessed DuPont, so now you're 1 in 29.
Okay. You know what? I will submit. Oh, Coca-Cola?
Close.
Oh, Pepsi?
No, not that close.
Okay. All right. What is
All
it?
right. The reveal. The reveal.
Oh.
McDonald's.
Oh, shame on me.
So here's what's notable here. They actually did not have a good quarter, and the stock ripped higher. This is the Journal. U.S. store sales and earnings fell at McDonald's as the burger chain dealt with the fallout of an E. coli outbreak. I don't even remember that. I guess that was last quarter. The company said its U.S. same-store sales declined 1.4% in the 3 months ended December 31st. Customers spent less money per visit. That's interesting. Also, a slowdown in the pace of price increases. So McDonald's finally ran into a price increase they couldn't get away with.
Well, they did that last year. So what happened? The guidance was better?
Yeah, expects to open 2,200 restaurants globally this year. That's a lot. That would be up slightly from the original total projected last year. 600 of those locations would be in the U.S. But it doesn't matter. The stock ripped because markets are forward-looking. Put that chart back up, and I am happy to announce McDonald's yesterday hit our list of the best stocks in the market. Here's my question to you. Mm-hmm. You see that resistance at 320 from last October?
I don't consider that resistance, but I see what you're saying.
Well, we were filling that gap. I think it's gonna chew through that level. What do you think?
Yeah, I agree with you.
It's a little overbought here, 75 RSI.
I made money on the stock last year. I bought it and I sold it.
Do you see that bounce off the 200-day? How legendary that is?
Yeah, it's pretty good.
I mean, dude, that's as telltale as you get, right?
Would you say that's textbook?
Yeah, it's a textbook bounce off the 200-day. All right, we're going to wrap up. I want to remind everybody, tomorrow is Wednesday, which means an all-new Animal Spirits podcast with Michael and Ben, Spotify, Apple Podcasts, wherever you like to listen, and live on YouTube slightly later in the morning. We're trying to get those videos up to you guys early. Ask the Compound will be later in the day, and an all-new edition of the Compound and Friends to end the week. We are en fuego here at the Compound. We love you guys. Thank you so much for joining us for the live. Thanks for listening, subscribing, watching, however you consume us. We love to be consumed, and we'll talk to you soon.